If you're an independent provider with a high 1099 income, treating retirement like a standard W-2 employee costs millions in compounded wealth over your career. Standard advice points high earners toward default brokerage accounts. These setups are designed for mass market simplicity, but they silently cap contribution limits and can trigger unexpected tax penalties as your income grows. Maximizing a 1099 retirement structure requires a specific trade-off. You must be willing to accept more administrative oversight in exchange for a larger annual tax shelter. The strategy that fits your business depends on three specific factors: your annual income, your current age, and your cash flow stability. Aggressive tax shelters create a mandatory annual funding commitment. If income drops in a slow year, you are still legally required to fund the plan, which can turn a retirement strategy into a significant financial liability. Choosing the right plan requires balancing your desire for tax savings against your need for cash flow flexibility. When you first transition to 1099 work, the most common recommendation from a CPA is to open a SEP IRA. The appeal is the lack of friction. A SEP IRA costs nothing to open and requires almost no administrative paperwork to maintain. However, a SEP IRA triggers the IRS pro rata rule. This rule requires the IRS to look at all your traditional IRA balances combined when you attempt to move money into a Roth account. Holding a pre-tax balance in a SEP IRA effectively blocks you from executing a tax-free backdoor Roth IRA. Any attempt to convert money later will trigger taxes on the conversion at your highest marginal rate. This comparison matrix shows why the solo 401k is the foundational choice. It avoids the pro rata trap, protecting your backdoor Roth. It also features two separate contribution buckets, employee and employer, that stack, sheltering more total income than an IRA. Accepting the administrative setup of a solo 401k now ensures your retirement assets can grow tax-free for the rest of your career. For earners over age 50, the Secure 2.0 regulations have created an immediate compliance requirement that most existing plans aren't ready for. If your W-2 wages from your business exceeded $150,000 last year, the law now mandates that your catch-up contributions must be made as after-tax Roth contributions. The problem is that most free solo 401k plan documents provided by major brokerages were written years ago. They do not contain the specific provisions required to support these mandatory Roth catch-ups. If your plan document isn't amended to support this rule, you legally lose the ability to make that $8,000 to $11,000 catch-up contribution. Relying on a free legacy plan template can cost older high earners their most valuable, time-sensitive tax shelter. A solo 401k caps your tax shelter at $72,000. For providers in the highest income brackets, this often leaves 6 figures of taxable income exposed. To increase that shelter, you can stack a cash balance plan on top of your solo 401k. This acts as a miniature corporate pension designed for a single participant business. This stacked chart shows the scale. By layering these plans, a single provider can shelter over $200,000 from federal taxes annually. But it requires professional oversight, costing $4,000 to $8,000 a year in compliance fees. Unlike a 401k, a cash balance plan is a legal contract with a mandatory annual funding target. Once the plan is open, you are required to fund it regardless of your business's performance that year. If you fail to meet those funding requirements, you face significant IRS penalties and high administrative costs to wind down the plan. This strategy is designed for providers with high, predictable income who can commit to a consistent funding schedule over a multi-year horizon. The cash balance stack is a powerful wealth accelerator, but its effectiveness depends on your ability to manage a fixed annual cash flow commitment. This map outlines the exact retirement setup required for each income tier. Tier 1 covers earners bringing in under $250,000, or those with highly volatile income. If you are in this tier, stick to the solo 401k. This setup provides the best balance of tax sheltering and cash flow flexibility without the burden of actuary fees. Tier 2 earners, clearing between $250,000 and $400,000 annually, have a more aggressive goal. You should aim to hit the full $72,000 contribution limit. This requires coordinating your S-Corp payroll to ensure your wages support the maximum employer profit-sharing contribution. This tier requires high payroll precision, but it avoids the long-term mandatory funding risks of a pension plan. For most independent professionals, a maxed solo 401k represents the ideal equilibrium between aggressive tax savings and operational safety. Tier 3 is for providers clearing over $400,000 with high income predictability. To maximize your wealth at this level, you should implement the full stack, combining a custom solo 401k with a fully funded cash balance plan. You must be prepared to manage the ongoing administrative requirements and the costs of running your own professional pension. By accepting that complexity, you can capture $70,000 to $110,000 in annual tax savings that most providers simply leave on the table. Action for this year must be taken soon. You need to coordinate with an actuary and establish the plan before December 31st to secure the deduction. While the easiest path is to use default brokerage tools, keeping more of what you earn requires a strategy built for your specific income level.